Okay, hello. Welcome to the Mortgage Insider. Today is August the 6th, 2025. We have a lot of interesting topics to talk about today, and I'm Daniel Jackson, loan officer here at Nova Home Loans in Yuma, Arizona. And I just want to these calls are designed for real estate agents, and I just want to share some of the stuff that I've come across lately that has helped in getting clients closed and also to brainstorm with everybody else. And so please feel free to jump in and share any ideas or questions or thoughts. We'll have time for FAQs at the end. But to get started, I'll just walk you through a quick agenda of kind of what I'm going to be talking about, what's on my mind, and the things that I'm finding that are working right now. Um, Most of this, I just keep track of stuff throughout the month and figure out, just think of ideas of what to talk about in these because just based on what comes up, different client conversations we have, different conversations I have with agents, and things that come up through my different coaching groups that I'm involved with. And so over the course of going through stuff like that, what we end up doing is just coming up with all kinds of ideas. So on the screen here, I'm gonna, and I'll put this in the chat as well, but this is if I can figure out how to do that, but this is a website that we put together with all of the links for everything that we shared today. And so you can go in there, get the links. I'll put the PowerPoint in there once we are all completed as well. And then you can just download the slides if any of it's useful to you. And you're welcome to. Dang, I can't figure out how to put this in the chat, and Paula hasn't logged on yet. So I will get it to you by the end if it comes up or if I'm able to. Okay, so we're going to talk about rates. There's a lot of discussion lately with mortgage rates, fluctuations. We're getting a lot of calls, and all of our clients, if you have any homeowners, past clients, then they're bound to be getting bombarded with all kinds of advertisements right now from mortgage companies telling them that they should refinance. And is right now the right time to do it or not? For most people, it's not. If they have a rate over 7%, then they might be able to benefit from refinancing. I have a few right now that are taking cash out or refinancing down to a rate in the fives from something like 7.25. Some of those make sense. Other people should probably wait, but we'll go through that. And then I've had some really good conversations with some first time buyers, including family members, nieces, and my own daughter the other day. And so I just thought I would share some of that rent versus own conversation with you as well. And as well as getting buyers off the fence. We had a really good discussion in one of my coaching groups about this topic of getting buyers off the fence, and I have a bunch of ideas to share on that. So as far as news, I saw this the other day. I thought it was interesting. Logan Motoshami posted on X that he says it took 12 to 18 months longer than I thought it would, but better late than never. And what this is a chart of housing inventory in the US. Now, these are nationwide stats. Every market's a little bit different, but you could see that the housing inventory number, if it was down here and it's dipped for the last few years, below the levels where it has ever really been. And even pre-pandemic, when inventory was super low, it was a frustrating time for home buyers to try to buy because there just wasn't any houses on the market and they would go really quick. Well, now we're finally back to the point where we are right at pre-pandemic levels. So that's interesting. Also, whenever you kind of zoom out on the market stats a little bit, it puts it into greater perspective. And I thought, okay, you see all of these charts, most of the ones that you see in the news stories lately just show the last few years where it shows, hey, inventory is starting to skyrocket. Well, put it into perspective by looking at this back to 2010, where inventory levels were and where we're at today. It's not skyrocketing, it's kind of getting back to where it needs to be. Um, But this is the news story that came out on, I think this was Friday, or maybe this was just yesterday. Mortgage rates hit lowest levels of 2025. So I'll show you on the chart what this looks like. But this is what consumers are starting to see is that, hey, we're getting mortgage rates that are a little bit lower than they have been. Now, the blue line on this chart, this is the Freddie Mac weekly mortgage survey. And this is a realistic look at what mortgage rates are doing, but it's not real time because they only release the rates one time a week. 6.72. Now, when they come out with it tomorrow, I'm sure it's going to be a little bit lower, probably be 6.6 something, maybe 6.63. And that is the lowest level that it's been all year long. not by much, but it is by a little bit. Now, this was a chart that I found on some website. Now I can't think of it, but this is the U.S. the history of rates that goes back to just the last couple of years. And what happens is every time you hit this level of 6.63, you get housing demand starts to pick up, and you see it's hit this level multiple times in the last 3 years. It's bounced below it a little bit, and I remember this time right here, October of last year, when we would talk to customers about refinancing, they could get a rate in the fives, and they said, well, let's wait to see how much lower it goes. And of course, instead of going lower, it bounced back and went back higher. So this is what we keep on seeing. And today, actually, we're seeing this again, where we've had a couple days, the rates hit that 6.63 on Friday. And now here we are on Wednesday, and the rates are starting to kind of level off again and go back up a little bit. So, it's normal market fluctuations. Now, something else that a lot of consumers don't understand about interest rates is that, okay, the rates, first off, are based on what the market is doing. But beyond that, you also have 30 something different factors that go into your mortgage rate quote, depending on what kind of loan type you're doing, your credit score, how much you're putting down, the type of property you're buying, what state you're buying in, just all these different factors come into play in looking at your rate quote. So this chart that I'm showing you is the Fannie Mae chart. So anything that's a conventional loan would come into this. So purchase money, you could just see like someone who has, say, a 720 credit score and they're putting 20% down. So that puts them in this range right here where it says 1.25. That means that if you were putting 40% down and you're over here in the zero range, if you put 40% down with the 720 credit score, you would have 0 points. And to get the same exact rate, if you're only putting 20% down, you're going to have to pay 1.25% in discount points, or 1.25% of your loan amount, in order to get the same exact rate. The interesting thing is, look at this. If you come over here to the right a little bit further, say you only put 10% down, then it's actually 1/4% lower in points. And if you only put less than 5% down, so say you're a first-time buyer and you're putting 3% down on a conventional loan, you're actually going to have a 0.5% lower discount points than someone who's putting 20% down with your same credit score. Doesn't really make sense, but what they're trying to do is incentivize first-time buyers and help to make it more affordable for first-time buyers. And so sometimes the numbers on these charts just don't make sense. The other interesting thing to look at is down below. It shows investment property and second home. Notice the large numbers down here. If you're buying a second home or investment property, you're going to have a much higher interest rate than you would on a primary residence, and that's because of these adjustments here. The other thing to look at is cash out refinances. I thought this was interesting, where if you're taking cash out at the same time as refinancing, there are adjustments for that as well. And you might pay a much higher interest rate than you would if you had a higher credit score, or if you were just refinancing to lower your rate and not take money out. So anyway, for what that's worth, there's also things called waivers, where if you fit certain criteria, then none of that's going to apply to you, and you'll have 0 adjustments instead of all those other adjustments. Some of the examples of that is right here. Loans to first-time buyers, if you have qualifying income less than 100% of the area median income. So depending on your income, you might have waivers and end up getting much better interest rate on a conventional loan. Okay. The other part that comes into something that comes up a lot, and people ask us, well, hey, I'm monitoring my credit on Credit Karma, and my credit score is 850 or 900. And then we go and pull the credit, and here's what we see. So for mortgage companies, what we do is pull all 3 credit bureaus, TransUnion, Experian, Equifax, and then we go by the middle score. We throw out the highest, we throw out the lowest, and we go by the middle score. So in this case, like this has a borrower with a 739 middle score, and then the co-borrower, the spouse, probably had an 818. Well, what we have to do is go by the lower of the 2 middle scores. So even though we have 6 credit scores here, the highest one is 819. The one we're going to end up using for mortgage qualifying is the 739. And then how that factors into your rates. Here's a little behind the scenes look at what we see as mortgage lenders. And this is from a couple weeks ago. It's not exactly live rates, but on this scenario here is a conventional loan. You can see that interest rates are as low as 4.875 and they're all the way up in the sevens. And it goes off the page here. It would go further, probably up to 8% if we had room on the page to fit it. But the point I wanted to make is that the way that we handle this with our clients is we'll give them full access to the whole rate board here and let them choose whatever interest rate they want. Now, we try to help them make an educated decision and one that's going to help them out and be in their best interest, but we'll give them access to this and let them choose whatever they want. The thing is, in mortgages, there's a lot of fine print in the advertising. And if you go and just Google what are the lowest mortgage rates today, if this says 4.875, somebody's going to be advertising the 4.875. And the fine print is this column over here to the right where it says credit 9.6. That means that in order to get the 4.875 rate, you're going to have to pay 9 points or $55,000 in closing costs in order to get that rate. So obviously there's just no way that that makes sense. It's never going to pay for itself to pay that much in extra loan fees in order to get the interest rate. But some of these do make sense. And what we're seeing a lot in today's market with the sellers paying concessions is if you can get the seller to cover some of the costs on your behalf, then you might be able to get a lower interest rate as a buyer. And so what I always do is just show a chart kind of like this one where we take the interest rates that we think make the most sense for their situation and we just show them side by side. Okay, you could get a 7.125 rate. You're going to need 100. In this case, they're putting a big down payment. This client was, but they're going to need 113,000 down. And then if they put 115,000 down, they could get a little lower rate at 6.99. Saves them $52 off their payment. And then moving down 6.6 or 5.9. So, the 5.9 compared to the 7.1 saves $430 a month. So that's kind of tempting. But notice they need about 20,000 extra out of pocket. And so what we do is with this side-by-side analysis, we do something called a break-even analysis that says, okay, over the next 2 years, which lately I've been using a 2-year term just because I think that makes the most sense. They're not likely to keep their loan longer than 2 years because of the way that interest rates are fluctuating. There probably will be a chance sometime before that to refinance to a lower interest rate. So in that scenario before, notice that the highest interest rate is actually the best deal for the customer. They actually save $6,900 compared to taking the lowest rate over that 24 months. Now, a lower rate always saves people more money over time, but in today's market, they're just not going to be in the loan long enough to reap the benefits of paying those extra costs to get the lower rate. That's my opinion. Okay, so let's talk about renting and some different things that we can use, some things we could share with customers. If you have someone who's on the fence and they're not sure if they want to buy right now, maybe they're waiting for lower rates or their payment's going to be higher than they want. There's a lot of ideas, and I'll skip through this, and then we're going to dive into a couple of them a little bit deeper. But one thing that somebody shared in our coaching group, he said this is working really well, is talking about how you can get tomorrow's rates today using permanent buy downs. So just what we had talked about of if you have the seller money that's going towards paying those discount points, then you can take advantage of the lower interest rate today without having to come out of pocket with your own money to do it, and then without having to worry about refinancing later. So that's a great approach. Seller concessions are making homes more affordable than you might expect, especially when it comes to those buy downs, and especially when it comes to tailoring your monthly payment to what you want it to be as a buyer. There's a lot of different down payment assistance programs that are available. Almost everybody will qualify for some down payment assistance. There's programs like the Hoper program where they'll get up to $13,000 of earned income for putting solar on the house at the same time they buy it. So you could combine an FHA loan on the purchase, add solar to the house, and get them $13,000 of down payment assistance, where to either pay down part of the solar, they could use it for their down payment, their closing costs, or whatever they need. We have other down payment assistance programs that don't have any income limits, so pretty much everybody will qualify for them. You don't have to have perfect credit. There's one program we have that will go down to a 580 credit score and still get down payment assistance. And you can even combine some of the down payment assistance programs with 2-1 buy downs and things like that. Um, if you have people that are thinking about selling their house or they're needing to sell their house before they can buy the next one, there's lots of buy before you sell options. Everybody's situation is a little bit different, and we've explored lots of these with lots of different people. But there's bridge loans. You can do a HELOC against your old house to take the funds out and use them for the down payment on your new one. In some cases, a VA loan is a great way to buy before you sell. We have clients right now that are moving over here and qualifying without having to sell their old house, doing zero down on the new one with another VA loan. So that's a great option for clients who have it. And then some of these bridge loan options will let you actually take out a chunk of your equity from your old house, pay off your existing mortgage on your old house so you don't have a monthly payment. There's no payment on the bridge loan, and then you can use the balance of the bridge loan for a down payment on the new house. So that way you can buy the new house without having to qualify for both at the same time. You can put a nice size down payment as long as you have enough equity in the old house to do it. Put a nice size down payment on the new house and not end up having to refinance the house later once the old one sells. That's another great option. Some people who can qualify for both houses at the same time will just put a minimal down payment on the new one and then plan to recast their payment later. But the point is, if you have somebody that needs to sell their old house before they buy the new one, let's talk to them. Let's at least have a conversation. It doesn't even have to be a loan application. We can just have kind of a discovery call where we chat, we go through the options, and we kind of informally figure out what's the best thing to do in their situation. The other thing to keep in mind is that property appreciation is likely to continue. And this is really important when talking to first-time buyers. Let me just go through a scenario. So here's one that I talked to recently. He was renting for $2,500 a month, and the house he wanted $440,000. So with an FHA loan, the down payment on that would be $15,400. This guy was 38 years old. He has a 401k with more than that in there. He was able to take the money out of his 401k. So no issue for down payment. The monthly payment comes out to $32.47, including taxes and insurance. So that's an increase of $750 a month. So he's torn with this decision, thinking, okay, should I really be taking money out of my 401k to invest in a house right now when my monthly payment is going to be $750 more than what I'm paying in rent? Does that even make financial sense? Well, first, you have to be able to afford the $32.50 because that's the check you're writing every month. In his case, it was fine. He felt like it was a stretch because it's more than he's paying, so it's more than he's currently comfortable with, but he could qualify and he could afford it. So principal paid is one thing that we got to pay attention to. Every month when you make your mortgage payment, part of it's going towards paying down the loan. So in a loan this size, that's $391 a month from the beginning. That grows over time, but up front, at least $391 of that extra $750 is going to basically go in a savings account where you're building equity in your house. That doesn't seem like a lot, but over 2 years, that adds up to $10,000, almost exactly $99.99.62. And at the same time, that $2,500 in rent, which he's just used to paying it, so he doesn't even think of it as money. But when I showed him this, he was like $61,000. That's how much you're paying in rent, whether you move or not. You're making that payment, so it does add up over time. Now, fast forward a little bit further to 5 years, and today's appreciation rate is forecasted about 4%. So if that house for 440 continues to go up at 4% a year, then once you hit year 5, you're going to have built up 131,000 of equity. Whereas with renting, you have zero equity. I didn't even run the numbers to say how much would he have paid out in rent over that same amount of time. But this really, I feel like, is the reason why we're in this business, is that real estate really is the biggest contributor of people building wealth in the US, especially just middle class, normal people. You don't have a lot of extra money, then what are you doing? You're trying to build up some money for retirement. A lot of people will put money in their 401k, but it's not going to turn into 131,000 in 5 years. That leverage of, remember, this guy only put down 15,400 up front, and in 5 years, this 15,400 has turned into 131 grand. Um, so that's the leverage of his money's not just going up at 4% on 15,000 down, going up at 4%. It's the full sales price of the house at 440,000 is going up at 4% a year. And that's the power of it. Now, I just figured, okay, look, if you were putting money in a 401k, say you make 100,000 a year and you're putting 6%, that's usually the max of what your employer will let you do. That comes out to about 500 bucks a month that you're investing in your 401k. Say you earn 8% interest on it. That's a pretty aggressive return for a 401k, but let's just say you did it and you're getting 8%, you're putting away the max, you're doing the best you can on 100,000 a year. It's a great salary. After 5 years, that's going to turn into 42,785. That's pretty good, but it's not 131,000. Okay, getting to tomorrow's rates today. Here's an example of a house that's listed for 325. They were considering dropping the price to 300. And so we talked to the sellers about this strategy instead. So at 325, somebody buying on an FHA loan is going to have a payment of $23.75 a month here in the first column. If the seller agrees to drop the price to 300,000, that's 25,000 less that the seller's going to net, and the monthly payment to the buyer is $21.92. So how much is that? $23.75, $21.92. That saves them 183 bucks a month for the buyer, and it's cost 25 grand for the seller. Well, doing a permanent buy down, so you could buy the rate down to 5.49 with about 2 points. So this cost over here where it says funds to closing 12,700. Say the seller just agrees to pay all the closing costs, including the points, to buy it down. You could still sell the house at the 325. The buyer's monthly payment would actually be lower than it would at 300, about 30 bucks a month lower. And then it only costs the seller 12,000 instead of 25,000, half the cost to the seller. Buyer gets the same benefit, and then a 5.5 rate. I mean, it's hard to say if we'll see rates lower than 5.5 ever. I think all the forecasts are that rates might hit 6%, maybe a little below 6%, but 5.5 is going to be tough. So you could take advantage of a 5.5 rate today. The house sells for the full price. Seller gets much closer to their expected net, and the buyer gets a lower monthly payment benefit right up front. Okay. All right. I think that's all I have for today. Let me see if I can get this. Into the chat. Okay. Did anybody have any questions? Chat. Okay. So I'll send this out in the replay as well and probably just put it in the YouTube comments. But in the chat, I put the link to all the resources from today. Within the next little bit here, I'll have all of the PowerPoint slides and the Zoom replay and everything in there. So feel free to reach out if I can do anything for you. And I hope you have a great day.